Now, since ESGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care because that just gets redistributed elsewhere. It's not going out of China. Never has done. And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there, but I should think it's quite a lot. I pencil in a figure about 10,000 tons.
For years, the Western financial establishment has treated gold as little more than a relic, a psychological hedge, not a monetary cornerstone. But in the shadows of this complacency, China has been quietly building the largest strategic gold position in modern history. Since the launch of the Shanghai Gold Exchange, over 27,000 tons of gold have been delivered directly into private Chinese hands, a figure that dwarfs official Western central bank holdings. And that's just what's publicly known. When you add the gold held in the exchange's internal storage accounts, including institutional and household accumulation plans run by major Chinese banks, estimates easily exceed 35,000 tons. That's the equivalent of more than a decade of global mine production, removed from Western circulation. And it has never left China. This is not merely a story of cultural affinity for gold. It's a systemic reconfiguration of global monetary power. Every ounce that moves east represents a transfer of real, tangible wealth, not in paper promises or derivatives, but in physical bullion. As Western nations leveraged, securitized, and rehypothecated their gold markets into layers of synthetic exposure, China opted for direct ownership. The result? A global metals market that appears calm on the surface, but one where physical scarcity is intensifying at an accelerating pace. The recent rally in gold and silver is not speculative froth. It's the first visible tremor of a tectonic shift long in motion. What's unfolding is nothing short of a reordering of the global metals landscape. The Western paper market system, once dominant through London and New York, is losing credibility as price discovery shifts eastward, toward Shanghai, toward Moscow, and toward real settlement rather than leverage. Investors who have followed these flows understand the significance. Gold and silver are being repriced not in dollars, but against collapsing confidence in fiat itself. And when this repricing accelerates, as it now appears to be doing, the consequences will reach far beyond the metals sector. As Alistair Macleod explains in this discussion, the implications extend deeply into the U.S. economy, the persistent debasement of the dollar, and the historical parallels between today's credit bubble and past currency collapses. He and Andrew Maguire unpack how we may already be standing at the threshold of a new monetary regime, one where the dollar's dominance is challenged not through warfare or politics, but through the quiet, deliberate remonetization of gold and silver. Before we dive in fully, please like the video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
But when you get a loss of confidence in the value of the currency, which is the top level of credit, if you like, in any economy, then that loss of confidence is reflected in a falling value for the currency. And that is exactly what's going on. So the idea that gold is overbought, oversold is rubbish. It's got nothing to do with it. Really, what we're looking at is the relationship between gold and fiat currencies, which depend entirely on faith. And it's as simple as that. So, well, where are we? I mean, I think we can really say that gold over millennia, basically, its purchasing power varies very, very little. And there's ample evidence of that. But when it comes to fiat currencies, they come and go. They don't last terribly long, is a short answer. I mean, the dollar has really been a fiat currency for some considerable time. I would say since 1933, if you like, just before, they devalued it from 20.67 to $35 an ounce. But more specifically and more obviously, since the Bretton Woods Agreement ceased, was suspended actually, in 1971. So we've had 54 years of pure fiat currency. But the destruction process actually started earlier than that. So we just bear that in mind. I think really what gold is telling us is that we're coming to the end of that era. And, anyone who's left holding the fiat baby is, basically has had it. That's what's going to happen. So that, I think, is the background. But the interesting thing is that the Chinese, who are a bit old-fashioned over these things, they didn't have the benefit of John Maynard Keynes teaching them economics. They came out of communism, if you like, with the belief that the capitalist system would fail. And of course, the failure of the capitalist system, would be through its currency. And so they started accumulating gold, really, shortly after Mao Zedong passed away. And I've got an English copy of the regulations dated 1983, appointing the People's Bank of China with the sole responsibility for managing and acquiring the nation's gold and silver reserves. And this is terribly important. It's important to know this. The second thing to know is that no one in China was allowed to own gold until it was legalized in 2002. And that was the point where the Shanghai Gold Exchange opened, which facilitated the delivery of gold to the public. So we had this period between 1983 and 2000 when China state acquired gold. And so where did it come from? Well, we had a massive bear market between those dates. And not only that, but, it was quite clear that quite a lot of central bank gold held in the West had actually gone out on lease, never to be returned. This was estimated by Frank Federosa to be somewhere between 10 and 14,000 tons. In other words, between a third and a half of all central bank gold was out on lease, sold into the market, and not coming back. Now, Federosa reckoned that it was probably adorning the necks of Asian women. I think it's another story. I think the People's Bank of China was in there quietly picking it up. I estimate, now I have no firm figures on this at all, and I have to say that the thing about the gold market, as we all should know, is that nobody wants to say that they actually own any gold. They want to keep it secret. And I'm not talking about individuals, I'm also talking about governments. And this is the whole thing. The US government is a prime example. I mean, we keep on wondering how much gold they've actually got. And what do they say? Nothing. So when it comes to China, I reckon that they'd accumulated roughly 20,000 tons between 1983 and that year, 2002. Now, since then, of course, the Chinese government has continued to accumulate gold. Not only that, but mine output is the thick end of 10,000 tons. I mean, China invested hugely in its own gold mine production and rapidly became the largest producer nation by far, eclipsing South Africa, which was declining quite rapidly as it happened back in the, I suppose, sort of 1990s and into the early noughties. And the other thing, of course, is that state-owned refiners were bringing in doré from abroad. I mean, particularly, obviously, Mongolia, and paying them for the doré. And where did the gold go? Didn't leave China. I mean, as far as the relationship between gold and China is that China is Hotel California. It comes in, that's no problem at all, but it can't get out. So that has been the policy. Why is it this policy? It's this policy because the Chinese understand the importance of gold. Now, since the SGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care because that just gets redistributed elsewhere. It's not going out of China. Never has done. And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there. But I should think it's quite a lot. I pencil in a figure about 10,000 tons. Now, I think that might underestimate the situation for the very simple reason that household savings rate is in the order of, it's over 30%. And that's the equivalent of $5 trillion a year.
What Alastair highlights about China's gold reserves is more than just a statistic. It's a reflection of a nation preparing for a post-dollar world. A savings rate exceeding 30% of GDP, amounting to roughly $5 trillion annually, creates a massive reservoir of capital-seeking stability. And in a society where gold ownership is encouraged, not penalized, that capital is increasingly directed into bullion rather than financial speculation. This dynamic not only tightens supply in the global gold market, but also lays the foundation for a domestic monetary system that can transition smoothly toward gold backing when the global fiat order falters. Western analysts often dismiss these developments as opaque or anecdotal, but the market response tells the truth. Premiums in Asian hubs remain elevated, delivery volumes continue rising, and bullion outflows from Western vaults show no sign of reversal. That structural imbalance, real metal flowing east, paper promises multiplying west, is the setup for what Macleod later calls the endgame of fiat currency. When inflation reemerges and liquidity dries up, investors will realize that their financial assets are merely claims on credit, not on value. And just as in past cycles of debasement, the repricing of gold and silver won't occur gradually, but violently. The current complacency in equity markets, fueled by speculative bubbles in tech and digital assets, is eerily reminiscent of 1920 to 1922 Germany, when asset prices soared even as the currency beneath them decayed. That's the stage we're in now, the euphoric calm before monetary reality reasserts itself.
This is actually a replication, if you like, of end of World War I, end of COVID. Okay? Purchasing power of currencies goes down. In other words, we saw inflation rising, interest rates rose with it. Now it is stabilized. And we've got a lovely period of anybody who's got anything in the stock market is doing wonderfully, thank you very much indeed. Making lots and lots of money with his Nvidia and his Bitcoin and God knows what. That is just absolutely the same as 1920 till 1922, the end of 1921. And what follows, we're about to see. And this is similar. I mean, it was the end of the Reichsmark, and it's going to be the end of the dollar and all other fiat currencies that sail with it. And what that means is, I mean, if you look at what happened, I mean, you know, all the stories about, wheelbarrows full of cash and all the rest of it, and the complete collapse of values. I mean, like property, people making money. I mean, one way in which you really will make money as a manufacturer is to manufacture to export to Russia, because Russia will go on a gold standard the moment China does. And what you'll see is your manufacturing costs sinking along with the currency, but your margins protected when you get paid in rubles or yuan. I mean, that's what Hugo Stinnes did, the inflation king, back in 1922 to 1923. He became the wealthiest man in the world. And basically his costs were in collapsing Reichsmarks, and his profits were in gold-backed dollars. And he owned something like a quarter of all German industry, when the thing ended. And Fritz Thyssen was another one. Now, Thyssen is a name we know from the steel industry, and that's still around. This is damn serious. What does it mean, for the gold price? In a sense, it's irrelevant. What's really relevant is the moment people wake up and understand it's not prices going up, but their currency going down, then they will dump their dollar deposits, their credit, if they've got any, just to get the hell out of it, and buy food, I don't know, anything you can get your hands on, because you don't want the damn currency, because it's going to buy even less by the end of the day. That's what we're heading for. It's a horrifying thought.
It is.
I think that this squeeze in the gold market, and also it's silver, and it won't be just confined to them, because if you look at the value of base metals, they've been left behind hugely in all this. I think that's going to be a big catch-up. The overall consequences of this, I think, are going to hit everybody very, very badly. But it does mean that you've got to hoard gold as much as you can. Silver as well. Of course, the other thing is that governments could be stupid, as they always are, and they decide, oh, we're going to confiscate gold. So keep it away from the government, keep it away from the banks, because the banks will do what they're told by the government. Keep it out from the banks, and don't tell anyone you've got it. Silver, I think it would be a lot harder for them to confiscate that. I really do. So that makes silver especially attractive in this collapse scenario. And also, it's probably, I mean, I don't see necessarily that we'll be going out and spending our gold or whatever, because that's not the role of gold, really. What we will do is we will find, our currency, we will liquidate whatever gold we need for currency, whatever its value, as it's needed. And you'll be able to buy a nice big mansion and country estate and all the rest of it for, sort of 10 ounces of gold. That's what happens.
Now, this is really timely, because I think what you're saying here, look, wake up, because this is real. It is a problem. It's going to happen. And obviously there is an opportunity. And especially you talk about gold and silver. I mean, look at every other currency, every other fiat currency that prices gold and prices silver has been through the roof, a lot led the way higher. And I look at CNY silver, Euro silver, forget 2011 highs in dollar silver. It's through the roof. It's just every day. It's higher and higher and higher. If anyone wants to me, I'm saying to everyone right now, why would you not go after, swap some dollars for silver now? Because it's so clearly, it's your arbitrage. It's quite clearly undervalued. They've been sitting on it a long time. There's obviously a lot of short stops above the market. Otherwise, they've raised the margins on it by now. And it's a panic. So to me, that's what I'm saying to people right now. Right. What should I do right now? And I'm agreeing with you. Silver has to be a bargain.
Yeah, oh, absolutely. And I mean, there's absolutely no monetary use priced in it. I mean, you've got a gold silver ratio of 80 odd. If it was going to be priced properly as money, you'd be looking way below that. I don't think we get back to the sort of Sir Isaac Newton, 14.5 ounces of silver to 1 of gold type thing. But I can easily see this below 30. In this sort of panic. And that does give you, sort of huge outperformance. And of course, the other thing is that while the institutions might be fretting about where the hell we're going to get all this gold, the average investor, the man who feels that he's missed out on the gold run is going to go for silver. He's bound to. Because apart from anything else, he doesn't have to fork out the thick end of $4,000 for an ounce. He can buy an ounce for around about 47, 48. So that is extremely attractive, I think, to most people. So I do see a bit of leverage there. The other thing possibly is, I think that institutions will go for gold mines and silver mines and so on. And I think the overall mining industry, I think, has been very, very suppressed in terms of its value. If you look at the main indices, they're more or less, talk about mining's, gold mine index or whatever. They're more or less doubled from the bottom, but this is from very, very depressed levels. But it does mean that you've got to have the ability to analyze mines, or at least know who to follow, which is probably, what most people will do. That introduces a degree of complexity, as well as that. If you buy into stock shares, whatever, basically you're buying credit again. And now I know people think that a company isn't inflation proof, or it gives you some protection from inflation. But the problem there is that it is still credit, because what you're doing is you're buying into a management promise to give you a stream of dividends. Well, they don't even pay that nowadays. So
You're just treading water then. You're just treading water. You're not doing anything.
yeah. I think the key to it, Andy, the key to the acceleration in the market is going to be when this credit bubble pops. I think we're within months of it. I mean, in fact, I think it probably happened by the year end. October seems to be, and here we are on the 1st of October, it seems to be a pretty good month for a crisis, for an autumn crisis.
The comparison to the Weimar inflation is not hyperbole, it's historical rhyme. Each period of excessive monetary expansion ends the same way, first with euphoria, then with panic. As currencies lose credibility, citizens scramble to exchange paper for anything tangible, commodities, property, or ultimately, precious metals. In the modern context, as the dollar and its fiat peers erode under unprecedented debt levels and fiscal excess, gold and silver are poised to reassert their role as the ultimate stores of value. The difference today is scale. This isn't a single nation losing control of its currency. It's the entire Western financial system facing a synchronized crisis of confidence. For silver investors, recent volatility has been unnerving, but it's also the most constructive development possible. A pullback after such a powerful rally is not a signal of weakness. It's the healthy recalibration of a market transitioning from paper control to physical dominance. Every dip provides renewed accumulation opportunities as industrial users, sovereign buyers, and long-term stackers compete for limited supply. With production already falling short of demand by roughly 250 million ounces annually, the supply deficit is widening, not shrinking. These fundamentals don't just justify higher prices, they make them inevitable. And while critics of precious metals have pointed to the rise of cryptocurrencies as a superior store of value, the recent divergence between gold and Bitcoin performance tells a different story. Digital assets remain speculative, vulnerable to regulation and leverage, while gold and silver remain tangible, liquid, and free of counterparty risk. For seasoned investors, this is the time to think beyond short-term price moves. The institutional rotation into hard assets is accelerating. Central banks are net buyers. The BRICS alliance is exploring gold-linked trade settlement, and the dollar's weaponization has made neutral, physical settlement more attractive than ever. The message is clear. The financial architecture of the past century is being rewritten, and those holding real assets will define the next. As Macleod warns, the months ahead could bring turbulence, credit stress, equity repricing, and renewed inflation shocks. But amid that volatility lies one of the greatest wealth transfers in modern history. Gold and silver will not only survive it, they will emerge as the new pillars of value in a world rediscovering the limits of fiat. If you found this analysis valuable, make sure to like this video, share it with fellow investors, and subscribe for more deep dive discussions on the evolving gold and silver markets. Stay informed, stay vigilant, and as always, stack wisely. Thank you for watching.